If you're ready, we can begin.
Let's do it.
Morning, Mr. Kaes Van't Hof. Thank you very much for doing this. I really appreciate your time.
Yeah, good to be here, Trevor. Excited.
For the listener, you are the CEO of Diamondback Energy, but to get it from the source, what is Diamondback Energy?
Diamondback Energy is a Permian Basin based exploration and production company based in Midland, Texas. We went public in 2012 at about $500 million market cap and 2,000 barrels a day. And here we are today, 2025, at $45 billion market cap, $60 billion EV, and almost a million BOEs a day of production, 600,000 gross barrels a day of production. So we're kind of the poster child for shale growth, and we've done it all in the Permian Basin through a big acquire and exploit strategy. And fortunately, it's been a good run for us.
And today is Monday, September 15th. It is 10 a.m. and you are willing to do this podcast. Some management teams talk about accountability, but others live it. You willing to do this? Taking the questions point blank, no prep required. So,
Well, Trevor, if I can't answer them, then that's a problem, right? We try to be transparent, try to be transparent with our investors, try to be transparent with our employees, and they enjoy stuff like this.
I've
As
done
do I. As do I.
I've done about 250 episodes of the podcast, and not many companies your size are willing to do this.
Well,
Did a
I
good
think
job.
I think there's a generational shift ongoing, right? I mean, I think there's a new generation of leaders. I like to put myself in that group, and I think we communicate in a different way, and I hope to see more of it. We need to be relatable. We're not just robots behind a desk.
Speaking of new generation, you are also one of, not if not the youngest CEOs of the major oil companies in North America. So congratulations.
Yeah, I'm competing with my friends across the street at Permian Resources, Will and James. I think investors think they're like 10 years younger than I am, but they're really only like a year younger than I am. They don't have the gray hairs of 10 years in a public company. So they'll get there, but it's a good friendly competition between us and Permian Resources. Their offices, I can literally see it outside my window right here.
Yep. You took a kind of unconventional path into the career in energy. I think you were born in Southern California, if I'm correct.
I was born in Southern California, a beach kid, Newport Beach, California. Played tennis in the morning and went to the beach in the afternoon. And energy was not something I had even thought about, going into college. I went into college as a finance and accounting major. Always wanted to kind of go on Wall Street and see where that took me. And now it took me somehow to Midland, Texas.
You were big into tennis originally. Was your goal to be a tennis pro?
I always wanted to use it as a means to see the world. My father was a really good pro tennis player. He was like 20, got it to like 23, 24 in the world in the 80s in singles, and then he coached two big pros, Todd Martin, who was a big American player, and then Lindsay Davenport, who got to number one in the world and won 4 or 5 Grand Slams and an Olympic gold medal. So I was always around tennis. As the oldest kid, you're kind of you're kind of the guinea pig to continue that legacy. And fortunately, tennis did a lot for me. It opened a lot of doors. It got me I got to see the world. I won the NCAAs in '08, and that means you can play the U.S. Open. So I got to play the U.S. Open.
Mhm.
I got to go to like 50 countries, 35 countries in 50 weeks, around the world in my 20s and see the world. And, I did it on a pretty different budget than I live my life under now. Tennis is a tough sport in the
Mhm.
lower ranks. You got to really, fight and scrap for every round and every dollar, but it was fun. I wouldn't trade it for the world. And, it ended up helping me get my first job in New York, and a lot of life experiences competing on a tennis court. Some good, some bad.
I think you played in the U.S. Open twice.
Got to play U.S. Open twice. The second year, I had a match point second round, and I think if we win that match point, I'm probably not here today. I probably would have kept playing. So in a lot of ways, that losing that match point, while at the time was very frustrating, was a blessing in disguise for the long term trajectory of my life.
First job, I think, was at Wexford Capital in New York in investing. How did you end up there?
Yeah, just before I started actually at Citigroup as an investment banking analyst. Coming off, I actually got introduced to some people that helped me, get my foot in the door from tennis, and always wanted to live in New York. I figured, you don't close any doors moving to New York in your 20s.
Mhm.
I did the banking grind for a year and a half, 2 years, and then I moved to Wexford Capital, which was, quite frankly, Trevor, it was the first job I could get out of banking, and I said, I'm taking it.
Mhm.
And Wexford happened to be a big, not only private equity investor and have a hedge fund attached to it, but they're big private equity energy investors. And at the time, they were doing some stuff in Canada. They were doing some stuff in the U.S. One of the big U.S. investments, ended up becoming what is now Diamondback, and that's how I got introduced to Midland, and
Mhm.
in about 2011, 2012.
At that point in time, were you thinking to yourself you would be a professional investor and that was the path you were headed?
I was just trying to I was just trying to do whatever job they asked me to do, and it was interesting. I was kind of the kid that could just knew how to model right from banking, and so I wasn't necessarily a good trader. I wasn't a good stock picker, but I knew how to model. And they're like, "All right, well, here's all this stuff we got going in West Texas, and fly down there and learn about the business, and then come back and build all the models because we're going to sell this, we're going to take this public, we're going to build this." And I just kind of kept my options open.
So you would have been about 30 at the time?
I was 25, 26. So
They-
26, Diamondback went public. This is in 2012, and they didn't need me anymore, helping out with Diamondback because it went public. So at 26, they gave me a vertical. The Wexford guys gave me a vertical drilling AFE for a
Mhm.
Wolfberry well back in the day, and they said, "You go move to Midland. We're going to make you CEO of this drilling company, and you're going to go build a bunch of businesses." And originally the plan was for Diamondback to use all those services, but vertical drilling kind of fell by the wayside right after Diamondback went public, and I had to tear up my business model and start over again. But it was a great learning experience. So 26 to 30 ish, or 25 to 30. I was flying from New York back down to Midland every Monday, and then back to New York on Thursday nights. And I kind of lived two different lives. I had a Midland life and a
Mhm.
and a New York life. Those are very different places.
I read that Diamondback ended its contract with your drilling company, and at that point, you were thinking about moving back to California to do real
Yeah,
estate. What?
yeah, no, yeah. It was tough. I mean, well, first of all, Diamondback flipped to a lot of horizontal drilling, right? So they went from one horizontal rig to five, and from six or seven vertical rigs down to one or two. And so that flipped the business model on its head. And then, if you think back to the time, ended 2014 through 2016, we had kind of had that business humming in 2014. We were doing about 10 million a month of revenue, 3
Mhm.
million a month of EBITDA. All 14 rigs were running. Life was great. And then, boom, Thanksgiving 2014, OPEC floods the market, and that's when the fun began. We went from that 10 million a month of revenue down to one. We had
Mhm.
one rig running. Um, but listen, I learned a lot through that experience. That and COVID are the two things that I kind of credit with teaching me a lot about how to manage through crises. You don't learn a lot when oil is $110 a barrel every day, and you're minting free cash flow. You learn a lot
Mhm.
when your back's up against the wall a little bit.
Do you think your lessons from tennis helped with the ups and downs in the oil industry, winning one day and losing the next?
Yeah, I mean, tennis is interesting. There's a funny stat that I like to tell people. Roger Federer, who is, we could call him one of the two or three best tennis players of all time. I think I mean, the most fun to watch. But that guy won only 52% of the points he played as a pro tennis player. I mean, that's crazy. He's one of the best of all times. He only won 52%. So you lose a lot in tennis. He ended up winning a lot more of those matches, but I would say the competitive fire is something that's helped me a lot over the years.
Do you remember when you first learned about Diamondback at Wexford, and what were you thinking at the time?
Oh, I was I was just trying to keep my job. Our former chairman, now our board member Steve West, said, "Hey, come with me to Midland, come meet this guy named Travis Stice. He's going to be the CEO of this business, and we're going to take it public next year." And I said, "Great. What do they do?" And he actually literally got on a whiteboard and explained how a well works. Here's how you drill it. Here's what happens. Here's what comes out. Here's your costs. And that was, my training ground to model the business. And it was on the ground training. And luckily Travis and the team here was very patient with me as a young kid trying to help them out. And Midland was a lot different then. It was pretty barren compared to today. It's almost doubled in size probably since then. So
Mhm.
definitely didn't have a Costco back then in Midland.
Yep. I think
Big step for us. We got a Costco this year
right.
out here. We're very proud of it.
The company was started in 2007, I think. What was the original value proposition for Diamondback?
Yeah, '07. It was basically just buying little Wolfberry leases. It was called Windsor Energy prior to Diamondback. The Diamondback name came about when it went public, and Wexford as a well, I would call it a non-traditional private equity company. Just did this stuff on their own. And they just bought leases and lease sales, and um, they had acreage all over the country. But this was as the shale boom was
Mhm.
starting to take off, and there wasn't a ton of drilling in the early years. It was more about asset aggregation, and then as the size of the business got bigger, it was time to raise outside capital to grow it, and that's why the IPO ended up happening in 2012.
Who founded Diamondback originally when it was private?
Yeah, I mean, you could say Wexford founded it. I mean, they just kind of bought the leases and
Hmm.
but then put a management team in place. So it wasn't like traditional private equity now today. You say, hey, NCAP puts $300 million behind
Hmm.
XYZ management team to go buy leases and drill stuff up. It was a different world back then. It was just, hey, they're going to just do this through the private equity funds, and then I think once they realized they needed to start to execute on a real drilling plan, that's when Travis came in and brought a team with them, and I think that was the best decision they ever made.
So the idea was they were looking for oil and gas exposure in Texas, maybe through the Permian, and they saw opportunity.
Yeah, yeah. I mean, this was meant one of their many oil and gas investments. It was not new to them.
Hmm.
It was just new that the shale revolution was taking off.
Which turned out really well.
It did turn out well. It turned out well. That was probably their best. Their best energy investment was, starting Diamondback with a couple $100 million, and then it became what it is today.
Diamondback's approach to growth has been through acquisition, which has made it successful and separated it. But what do you think the company's done differently to grow through acquisition successfully?
Yeah, I think there's a couple things. I think in the early years, organic growth was rewarded, but you need a lot of acreage to grow organically. And so we've always been an acquire and exploit company. Those early years, we did a lot of our deals with 100% equity. So we used all equity financing, particularly because there wasn't a lot of development on these acreage positions. And that, I think, kept the balance sheet in good shape and allowed us to continue to do more and more deals. And then, on top of that, we were growing organically through that, acquisition strategy. And then, as we've gotten larger, And as organic growth has slowed from us, I'm not saying it's dead forever, but it's slowed, pretty significantly from the early days. We've used our currency, to do accretive deals and grow, per share metrics. And listen, all this is attributable to one main thing, which is, our cost structure and our ability to generate higher returns and drill wells cheaper than everybody else in the basin. We are the low cost operator, and we firmly believe that, the commodity based business, the low cost operator wins, and that's kind of what's happened over the years. Pretty consistently, right? And I think the other point is if we ever do lose that edge, right? If we do lose that competitive edge and that cost structure edge, then the roles might be reversed because we need to be the best at what we do, and we benchmark ourselves. We hold ourselves very accountable to that, and that should allow us to continue to consolidate assets.
And one of the deals you were around for, I don't think you were the CEO at the time, was the Endeavor deal. Do you remember when that started to be talking about? And what were your thoughts at the time?
Yeah, that was a pretty wild time for all of U.S. shale. If you go back to kind of the end of 2023, you had Exxon made their move on Pioneer, right? And that was kind of a pretty significant deal, a very significant deal in the basin. Once that happened, Chevron moved on Hess, and this was all during a time when deal scrutiny under the Biden administration was pretty heavy, with everybody getting second requests. And after that, that kind of left the two big buyers of big assets on the sidelines. And we were trying to buy Crown Rock, which ended up going to Oxy. They beat us out on that one, but that tied them up. And then it became kind of apparent to us that Endeavor might be selling or looking at selling the company. And we tried to approach it as a very friendly idea of merging the largest public company based in Midland and the largest private company based in Midland. And I think we snuck one out. It was certainly a competitive deal. We played it like we're friends across the street, and we offered a lot of opportunity to the Endeavor employees versus maybe selling to a larger company. And it's been great. It was a pretty good feeling knowing the deal had been done and inked when it leaked to the Wall Street Journal on Super Bowl Sunday of 2024. And let's just say that was a fun Super Bowl to watch, Trevor. That was probably the closest thing I've felt to winning a big tennis match or winning a national championship. The feeling of those two companies coming together, and now seeing the benefits that we've been able to bring on both sides. Not only to the company but to Midland in general has been it's been a fun sight to watch.
And it never wasn't founded by the late Mr. Autry Stevens, who was a legend in his own right. Do you remember meeting Autry and what that was like?
Yeah. Listen, everybody in Midland has Autry stories, and he stuck it out, right? I mean, he was buying leases in the '90s and early 2000s when it was, the Sprayberry oil field which was what it was called, was known as the world's most uneconomic oil field. So he was here just chipping away, grinding, and buying leases every weekend or every week at lease sales. And his work ethic was pretty legendary. The guy didn't take a lot of days off. Was a very humble man who just wanted to drill oil wells. And a lot of that culture is still prevalent today at Diamondback. And we like to always kind of say something. A saying that we have over here is "Stay humble, stay hungry." And I think being in Midland does that to you. If you try to act like a big shot in Midland, the town will kind of chew
Mhm.
you up and spit you out because there's a guy in overalls eating next to you at the diner that's probably worth a couple $1 billion, and he's not acting like a big shot. So why should you? But Mr. Stevens' legacy still lives on here, and it's unfortunate that he passed before the deal closed. I think he'd be very proud to see what he built combined with Legacy Diamondback and what it is today.
I read that one of his strategies was to acquire leases and hold them to keep optionality. You never know what might be in those leases. Do you approach it that way at Diamondback with trying to preserve optionality in the company?
Yeah, I'd say we've learned that because I think generally, if you look at what's happened over the last 20 years, the good rock keeps getting better, and there's always option value in this acreage. I personally regret every operated acre we've ever sold in the basin. So we're kind of in a I like to call a resource hog mode where we want to keep as much resource as possible.
Mhm.
There's still so much oil in place that we're not touching today in the Permian, and I think there's going to be breakthroughs from a technology perspective. Price also helps over time, and I think there's going to be a lot more oil to be produced out of this basin. So let's keep as much of it as possible.
And on the subject of producing, the debate is usually between spending capital and returning it to shareholders. How have you thought about balancing the kind of back and forth between spending and dividends and buybacks? What are you thinking nowadays?
Well, I mean, I think if you think about but when this whole capital discipline model came about, it was kind of the end of 2019. All the companies were growing too much, U.S. production growing too much, and investors said like, "Hey, time out. We've given you guys a lot of money. We need some of it back." And I think it was we were on our way towards a more disciplined model, but COVID really flipped that on its head, right? And so COVID was essentially a near death experience for the entire industry, right? There wasn't a company that was spared stress during that time, and I think that really put a lot of companies from a strategic perspective start thinking about, hey, maybe we should spend less than we make and return cash to shareholders, and that's been a model that's worked pretty well here for the last 4 or 5 years, particularly as oil prices have been very volatile, and there hasn't been a lot of room for growth. I think that's going to stick around for a period of time, particularly if we're around the $60 WTI range, and there will be a call for growth at some point. There's going to be a mismatch between supply and demand. I don't know when that is. We're all long-term bullish, Trevor, or else we lose our minds. But I think the key is to have the optionality to be able to answer that call if it ever does come. But for right now, it's spend less than you make, return it to shareholders, shrink the share count, pay dividends, and when oil prices do rise on the other side of this, there's going to be a lot less shares in the market for people to buy. Should be a higher price.
In vanilla terms, do you view that as a production per share growth, cash flow per share growth? Do you view it as a steady yield that's rising? How do you think about that?
I think it's all per share growth, right? I think when oil prices are low or flat, you need to grow per share by either growing a little bit organically or cutting your share count. And then when oil prices rise, the rising price naturally takes care of that for you. So I think it's all about the long-term cyclicality of this business, and knowing where you are in the cycle, right? I mean, I think the hardest thing for someone to do is to say, "Hey, I'm not going to buy back shares here because oil's $80 or $90 a barrel, and my stock's at all-time highs." That's when you need to pull back. It's not when things are low. That's when you need to kind of step in and lean into buying back shares, which is something we're doing today.
Mhm. What do you think about dividends? Are you leaning towards, without giving away your plans, is it a dividend something you see in the future, maybe
Oh
rising?
yeah, yeah, yeah. Listen, the base dividend we've had a base dividend now since 2018. It's continued to grow pretty aggressively. I think it's going to grow a little slower, right? We started very small at 50 cents a share per year. Now we're at $4 a share per year. So it's been a big, a high growth, um, dividend relative to anything else in the market, and that's going to continue to grow. I mean, in my mind, Trevor, that's debt, right? That the interest on your debt is the same as paying your dividend, and we want to consistently grow that dividend, over the long term. Now, what allows us to do that is having a lot of inventory to drill and a low cost structure and low break even, where when we pay down debt or buy back shares or cut capex, that gives more room to grow the base dividend, which we like to run our model and say, I want that base dividend protected at $40 a barrel, and as long as we keep working on our break even, that gives us room to grow that dividend.
And on the subject of growth, Diamondback has grown a lot through the years, which raises expectations and can be great, but sometimes the share price can get ahead of itself. How do you, not saying that it is now, but how do you navigate expectations of growth given the success of the company? How do you tell that, how do you paint that story to investors?
I mean, I think you got to be patient, right? You got to know where you are in the cycle and what's the right capital allocation decision to make at this point in the cycle. I think with commodity prices lower, it means spend less capex and return more cash to shareholders through buybacks. And then on the other hand, if commodity prices rise, it's, hey, use all that free cash flow to pay down debt or grow a little bit organically or do accretive M&A. It's all about being ready, for the right opportunity at the right time. And we've been fortunate to be in a position to do that more often than not over the last, 10 years. And it's all about, being ready and staying well positioned, which we, intend to do.
And because of the success of Diamondback, the company's gotten pretty big. Do you view the scale and efficiency of the large company as an advantage in the basin these days?
I think if you asked me that question 5 or 6 years ago, I would have said, size and scale, it's important, but it's not a game changer. I think my tune has changed. Maybe that's my cognitive bias because we're a bigger company, but there are a lot of things that have come our way from being this large and also being concentrated in one basin. And that's, with the advent of, simul-frac on the completion side, it's buying power in terms of drill pipe and, rigs and services. And it's, being able to run a more consistent program. We used to have to run a frac crew for a period of time, then lay it down, then bring it back. I mean, the ability to run consistently has, I think, accrued to our benefit and created a lot of efficiencies. I mean, it's pretty amazing if you think about it today. Back when I was running the Bison drilling company, drilling a vertical well in 15 days was a win.
Mhm.
And today we're drilling that same vertical plus 10,000 feet of horizontal in 4 days. I mean, it's pretty wild. I told the guys, I can't wait to see the first 1 day well. It's pretty impressive the amount of efficiencies and the amount of costs that the team has been able to drive out of the business.
In Canada, the industry is consolidating. It's in a process of becoming a few players that take advantage of scale advantages. Do you think that is on its way or happening in the States in the Permian, or what do you
Oh
think?
yeah, oh yeah. I mean, I think it's been happening for a while in the States. I mean, that's kind of the product of coming out of COVID and the new kind of business model. I think there's going to be essentially a basin or a basin champion or two in every basin. So you've got your Bakken consolidator, you've got your Marcellus and Utica consolidators, you got Midland Basin and then Delaware Basin, and you're really starting to see a lot of assets accrue to the basin champion, and in our mind, that comes from size and scale, but it also comes from the ability to execute at the lowest cost. And I think you'll see it. I don't know. You guys have some public deals going on in Canada right now. I think you're continuing to see it there, and you'll see it here.
And from a operational perspective, what would be an example of driving costs down? How do you do it? What would be some of the things that Diamondback is working on?
Oh, we're always working on getting well costs down. I think what separates us is that culturally, we incentivize it and we support it from our employees, right? I think the status quo is never acceptable at Diamondback. We're always pushing, hey, what can I short set this casing to save, an hour of drilling? Can I use 6 inch casing versus 5.5 inch casing to get a better frac job on 15,000 foot laterals? I mean, there's a constant innovation culture here, which and if someone makes the wrong risk adjusted decision at Diamondback, it's not like you're going to be punished. We're going to support you, but we push a lot of decisions down in the organization so that the people that are closest to the wellhead, who probably know more about what's right and wrong than I do, or they definitely do. They're incentivized to keep pushing the limit.
Running the same drilling crew with specialized knowledge that helps with efficiencies is one way to.
Yeah, it's just listen, it's just experience, right? I mean, we've drilled, we're drilling 500 wells a year. We're going to keep getting better at drilling those 500 wells a year. And everybody that works for us is essentially a basin expert, right? There's no other basin for them to go work and or move to a different country to go work a couple of years. It's if you're a drilling person or drilling engineer at Diamondback, you are 100% focused on drilling the best wells possible in the Permian Basin every day, and that over time, the natural efficiencies start to show.
What's the biggest opportunity you see for Diamondback in the Permian, and what's the biggest challenge?
I mean, I think the biggest opportunity is probably, what is going to happen from a technology perspective in terms of, increasing recoveries. We're only recovering, let's call it 10% of the oil in place. There's a lot of oil left to be recovered. It's just not technologically viable to be able to do it yet today. So I think there's going to be some amazing things that come about over the coming years. I don't think it's tomorrow answer, but in 10 years from now, what are we going to be doing? What are we going to know in 10 years from now that we're like, I can't believe we didn't know that 10 years ago? And that's going to keep happening in this basin. From a challenges, I think I think it's we've been very vocal about it. I think it's clear that tier one inventory is not infinite, and having as much of it as you can to be able to get through this cyclical business is going to be important. And it's something we continue to think about and manage. And but that's our job, right? We started with 30,000 acres and 2,000 barrels a day of production. We've had to work our way up to where we are today, acre by acre. And again, and going back to what I said earlier in the conversation, if we maintain our cost structure, I think more acres naturally come our way.
Well, we'll get into the state of Permian and shale production, but the critic would say that they're running out of tier one acreage. But on the other hand, my point is that there's always a entrepreneurial spirit within the basin, and people are always looking to find new ways to drill the oil. Do you view it that way, and that you just don't know what the acreage that you have, and there's always new technology coming down the line?
Yeah, listen, never underestimate the American engineer or the
Yeah.
Canadian. We can go Canadian too, but
Yeah.
the stuff that has been figured out over the last few years, compared to where we were 12 years ago. To just think about it, 12 years ago, we were drilling 100 vertical wells a year. We drilled zero vertical wells a year now. So, I'm excited. I think that technology will continue to help the business, but I also can't bet on technology to bail you out, right? And so that's why we have to have the best inventory and the best cost structure today from what we know, and be able to continue to push that forward.
The entrepreneurial spirit of the industry is something that's hard to quantify, but it still exists. How do you present that to investors? Do you just like we're doing right now?
Yeah, I mean, they have to come see it, right? I mean, I think a day at Diamondback or going on a rig or frac tour at Diamondback and getting exposed to different people besides me here, you can really see the brains of the operation and what they bring to the table. I mean, I think we have a very close management team that all gets along very well. I think that drives culture. I mean, I can't hammer the culture point enough that we're a small company that got big. There have been some processes that had to be put in place because we're naturally bigger, but that small culture that started in a single office in this office building 12 years ago, 13 years ago still resonates, and you can feel it. So yeah, I mean, I think discussions like this are important, but I think also just, meeting more of our management team and our employees in Midland, and just being around town and hearing how we do things is important too.
And are there clues that you look for? Maybe it's the engineer who comes to the field on Saturdays is tinkering, the landman who won't give up on the lease. What do you look for, or what do you point towards in that kind of intangible culture? What,
Listen, we go through every well drilled and completed every quarter, and the engineers have to go through it in front of the management team. And listen, not every time everything didn't go perfect, right? So we're not afraid to figure out what went wrong, what's working, and work at it as a team. But that engineer knows if they're giving me bad news in our quarterly review, it's not like, you know it's not off with their head, right? It's okay. Well, what do we do? What do we change? What are we doing now? And everybody, kind of has each other's back here.
hmm. Another way to keep costs low in the energy business is to own your own infrastructure and control that side of the business. How do you think about infrastructure and the importance of takeaway capacity, water, and that side of the business?
Yeah, we built a lot of infrastructure ourselves. We traditionally have built all of our water systems, and as those systems matured, we've sold them into a JV called Deep Blue. So that manages all of our water. We retain 30% ownership, so we still have some influence, but a lot of the infrastructure was built out, so it wasn't like we were having to do a bunch of organic growth around that system. So that's in good shape. On the other on the egress side of things, to use your Canadian term, we've always tried to use our balance sheet as well as our production to get projects online. We've participated in 3 oil pipes, and 1 NGL pipe, and 1 gas gatherer and processor. And fortunately, we've always taken equity in those projects, and the equity that we took, helped us drive decisions to get the project to FID, but also we made some money on it. And but when we do sell our interest in these pipelines, our commercial interests are protected via the contract with the pipelines. We've always tried to manage making sure we're commercially protected and try to make some money on the side, developing infrastructure out of the basin.
The egress, as the Canadians would call it, isn't as
Yep, egress. We call it takeaway, but I can call it egress.
it's not, I don't know if it's as big of a problem for you in the States it is as it is in Canada, but do you view it as necessary to own all the infrastructure? How do you think about that?
I mean, I think it depends who you are and what play you're in. I think we're fortunate. We're very fortunate in the Permian to have a state that it's very easy to build pipelines in. It's very easy to build gas plants,
Hmm.
and really, I think the issue we've had here is that the gas growth out of the basin has always exceeded expectations. So we've had, you have your AECO prices, we have Waha, where we have had negative pricing or $0 pricing a lot over the last 5 or 6 years. I think, fortunately for us here, there's been enough new capacity announced or in process of being built that those issues are going to finally go away for a period of time. So I think we share similar issues. It's just easier to build a pipe here than it seems to be up in Canada.
Do you view it a priority to be tapping into different markets around the country to provide security in your pricing?
Yeah, I mean, on the oil side, most of our oil goes on the water. That try to get to the biggest market, which is the liquid market on the water. But on the gas side, there certainly seems to be a wave of excitement about natural gas and its use for power in the U.S. and obviously LNG and the amount of exports that are coming out of the U.S. there as well. So I think on the gas side, we'd like to get more diversification to more markets, which we've tried to do via the pipelines that we're committed to today. I think I'd like to get some West Coast exposure if we can, but really it's a big portfolio effect, and And the answer needs to be, we need to be closer to the end markets in terms of controlling our gas.
And one of the uses for gas has been for AI data center use. Have you had interest from large tech companies for the gas?
I think there's certainly a lot of noise about it. I think we think that gas out of the Permian can be a great source of power for data centers or even power plants that we need for our operations. We're trying to convince them to come to West Texas. There's a big development in Abilene, a couple hours east of us, called Stargate, that's going to use a lot of gas. And yes, I think eventually, connecting to the grid is going to be hard for some of these data centers that need gigawatts of power,
Mhm.
and maybe they should just come out to West Texas and build it behind the meter with us.
Have they
But we'll
been,
see.
it hasn't been inquiries so far? How does that work? Have they been,
I'd say there's inquiries. I think the big boys are getting offers to connect all over the country every day, and it's going to be a matter of, okay, when does all that capacity get used up and all the brownfield capacity is used up, and then they need to come, talk to people like us about greenfield opportunities. But listen, gas is 5% of our revenue, and I think it'd be fun to have a data center in West Texas, but it's not the be all end all for our story.
as we
We got
head,
to get the oil side right.
right? And so, on the subject of oils, we head into this fall of 2025. Oil prices have been around $60 WTI. You've been pretty upfront on your concerns for that in the industry, the US shale industry. What are your thoughts now? Do you still view it as a problem or is it a mixed blessing? What are your thoughts?
I don't see much positive out of $60 oil, but I think you can see it, in the equity prices and in the numbers and the free cash numbers at companies. Some companies have a harder time at $60 oil than others. I think for us, we'll be fine. I don't love it, but it's I kind of like to say it's a malaise. But I think what we've tried to set up is, and this is kind of goes back to this new business model of a low reinvestment rate, high free cash flow generation, is that at $60 oil, Diamondback still generates, almost $5 billion of free cash flow a year. And we can use that free cash to buy back shares, pay down debt, and get through this. Whereas in the past, when oil prices cycled down, you had companies either issue equity or have to cut a bunch of capex to be able to pay down debt. Well, here we are trying to buy back shares through whatever trough this is, and I think investors may not recognize it right now, but if they look back and say, when oil prices do rise, and they say, hey, this company actually like did fine and bought back shares and lowered the share count and paid their dividend and didn't have to do anything too drastic, I think it's a sign of a potentially safer business model, right? This business model, this business will never be, a utility, but I
Mhm.
think if we can try to take some volatility out of the business by being able to repurchase shares through the lows, then I think that gets rewarded long term.
The balance is between supporting the sector with, I guess you could call higher oil prices, but on the other side, there's the US consumer who you might say wants lower oil prices. How do you think about that subject with the administration and not getting too political, but how do you balance?
Well, my take is oil's done its part, right? Oil on an inflation adjusted basis is as low as it's almost ever been. It's the lowest. I saw some data the other week. It's the lowest part of an average consumer's wallet, or lowest percentage of an average consumer's wallet in the last 25 years. So, I mean, I would say go look at how much is inflating other parts of the economy. Now, um, that's a selfish homer take, but I think if you think about in retrospect what U.S. shale, both on the gas and the oil side, has done for the U.S. economy is nothing short of spectacular, right? I mean, we used to import almost 10 million barrels a day of oil. and all those LNG facilities that are up and running, or some of the original ones were meant to import gas.
Mhm.
And now if you just think about the U.S. economy running on the cheapest feedstock in the world in terms of gas prices and even oil, that has really advantaged the United States, over the last decade and a half. I don't think we get enough credit for it as an industry, but
Mhm.
that's probably a deeper discussion. But I think just generally, over the last few years, you had oil prices in kind of the 65 to 85 range, and people were kind of looking in that range and not looking too far up or too far below, and that seemed fine. And now here we are at, call it $60 oil, but everybody's looking down, right? And so that from a sentiment perspective, I think is the issue.
And if oil does continue to go down or tier one acreage maybe isn't what you thought it was, do you ever think about looking north to Canada for inventory where it might be on sale for you?
Listen, I think there's a lot of good inventory in Canada. It's not my area of expertise, given that we're in the Permian, but I think you'll see consolidation continue to happen up there, and we'll see if there's some big companies up there, and there's a lot of acreage in the hands of what I would say is kind of the forever owner. So, it's our job to find the best rock, but right now that's kind of all here in West Texas.
It would seem obvious with a strong currency and a favorable balance sheet to look north, but it sounds like a lot of the US producers have enough on their plates in their own areas.
Yeah, I think so. I think there's still consolidation to happen in the US. I mean, I've heard rumblings of people learning, at least getting smart on Canada, or other companies getting smart on Canada. There's clearly a ton of resource, obviously, with oil sands and what you have going on the western side of the country. You guys deal with a lot of the same issues we deal with in terms of egress, and that can impact your numbers, right? But there's certainly a lot of resource in both places, and we should jointly exploit that.
What would it take for you to look north? A good pitch, or the right
I'll
relationship?
come, yeah, I'll come see you, Trevor. You can take me around Calgary next Stampede.
Yeah, we're building relationships on this podcast. For
That's right. That's right.
I know you don't have much time today. Maybe a couple questions from X,
Sure. Yeah.
if that works for you. This one comes from an account titled Rock Creek Freak on the subject of Autry Stevens and the Endeavor acquisition. His question is, Autry seemed like a legendary dude. What was the negotiation like? How did you can outcompete other super majors, and how did you end up with the deal?
Yeah. I mean, listen, he is certainly a legend, and I think, as I kind of mentioned earlier in the podcast, we really tried to play this like it was a friendly deal. This isn't a takeover. We treated it like a merger. Autry really cared about his people. He had built up a business with, nearly 1,000 employees, of which, we had 1,000 as well, and over 90% of them ended up coming to work for us. And I think that they've been in the building across the street from us for forever. They were in it before we were, growing in this building across the street. But really tried to play that relationship. And Travis, our former CEO, now exec chair, and Mr. Stevens had plenty of time together over the last couple decades. And I think there was an inherent trust that we were a good steward of the assets, but also a good steward of the people. And that's how it kind of shook out. But yeah, it was, we like to consider ourselves an underdog, Trevor, and we pulled off a little underdog story there, snatching that deal.
This one comes from an account titled Andy. What would your advice be for mom and pop operators operating in the Permian these days? Maybe if they're looking to sell or compete with in the area?
And listen, I think you either need to be really, really small or really, really big. And if you're really small, you can be nimble and do little deals because those still exist in the Permian. I think you just have to have the inventory or production to get to this, uh, you know, light at the end of the tunnel. Because there's going to be in my mind, I've now never been more confident that there's going to be a dislocation in price between supply and demand here at some point before the end of this decade, and you just got to be there to enjoy it.
And this one's from a account not coincidentally titled Autry Stevens.
Okay.
Outside of the Barnett Permian/Permian, what other zones are emerging or new plays that are being talked about at the C-suite level? If you can, without giving
Yeah, listen, there's a lot of excitement around the Barnett Woodford. We've amassed a pretty sizable position there and starting to drill more and more wells. I think we got to get the cost down, but the wells are certainly um, you know producing at or above the average Midland Basin well. It's just deeper and more expensive. I think we've had a lot of success in the Upper Sprayberry, which is kind of a new zone that's come about in the last 3 or 4 years. Wolfcamp D, which is well known but not hasn't been as economic, is starting to look more and more economic. And I think as the Permian progresses, you're going to see operators really try to test the outskirts of the basin, and some will have great success and some will have a harder time. But I think it's on us to, well, that's the entrepreneurial spirit of the basin. But two, I think it's on us to make sure we follow closely to what's working and look over the fence line, because I think there's going to still be stuff that's discovered in the Permian that becomes very economic.
as we come towards the end of the conversation, what excites you most about Diamondback, the fall of 2025? What gets you out of bed in the morning?
I just have the privilege of representing 1,700 families every day, right? I mean, that is the key to getting up in the morning and going to work. I mean, we've built an incredible company, not because of me or because of Travis, but because of the 1,700 people that show up every day and make this a great place to work. We got a great culture. We've always kept a pretty lean organization, so everybody works pretty hard, but I think we've been rewarded in terms of what the company we built. So that's what I would say.
And what message would you leave for investors? What would you tell them?
We need to find some new ones. I think, generally, I think investors are kind of sitting on the sidelines this year with all this macro uncertainty. We continue to be the biggest investor in our own stock by repurchasing it almost every day, and I think that means at some point there's going to be less shares on the market and more reward for those investors that are sticking with us.
I really appreciate your time today. Maybe we can catch up next time you're up north for the Stampede.
I'll come see you, buddy.
And unless there's anything else you want to add, we can end the formal conversation there.
Yeah, no, we're all good. I appreciate you making the time.